Welcome to Chapter 1, Introduction to Accounting. I would like you to print this off and fill it out as we go along. So this is pretty important so we can spend some class time or other work on just actually reviewing some of the problems. So we're going to talk about accounting and business this semester. And here's our objective. So I'm going to come back in the end and come back to these. Hopefully I'll remember to do that and see if we've covered them all. But what is the nature of a business? And basically, we organize in the form of a business to provide resources or services to customers. And our objective is to earn a profit. So we do have a profit objective in a business. Here's some just different types of businesses. Remember, you can have a business be a service or product, what we're serving. Fulfilling a need in public and with the hopes of making a profit. So what is accounting? I want you to define this in your own words, the role of accounting in business. So basically, if we're going to have, later on in this chapter, we're going to have owners of businesses, but those owners of business can be us, and those owners want to know how we did. And basically, accounting is the report that we file with the owners or give to the owners to show them how we did. So we're going to see who uses it, and we're going to figure out what do they need. A lot of times, how much did we make might be a question that you have. Design the accounting system to meet the user's needs, and record the data and prepare accounting records. So for instance, many of you have organized fundraisers or participated in fundraisers. So let's say that we had a fundraiser because we wanted to take a band trip to Washington, D.C. Okay, so we are going to sell pizzas to raise enough money on the band trip. So basically what we need is information on how much that band trip is going to cost and information on how much we're going to sell our pizzas for. And so we're going to design our accounting system to keep track of costs as we go along and also the revenue from the pizza sales, and we hope in the end we make a profit. So we're basically going to design the accounting system. So you're going to ask yourself, how are we going to keep track of the costs of the trip? What are we going to do? And sometimes that's just as simple as handing your receipts to somebody, but somebody's got to write it down. So whether they'll make an Excel file or a piece of paper or whatever, you will design an accounting system to meet those needs and to record the data so we know if we were able to pay for a trip or not. The next one is managerial and financial accounting. Managerial is usually for internal users such as managers and employees, but basically things like how much do we need to sell a t-shirt for, so I need to figure out the cost of the t-shirt or the cost of the pizzas. In our case, where we were going to travel on the trip to Washington, D.C., that was more managerial information. We call that private accounting because you're working for a business itself, and we'll get into the difference between that and public accounting. Financial accounting, on the other hand, provides external users, and these external users are, this is important, investors and creditors are the biggest external users. Some other ones are customers and the government. But financial information is for external users. So the objective of financial information is to provide relevant, timely information for the decision-making needs of users outside the business. So we have what are called general purpose financial statements. We have to put together financial statements that will satisfy these users' needs. So what I like to kind of say, financial accounting is more akin to, let's say, if you play intercollegiate athletics, you have the rules for the sport. That would be financial accounting. So somebody can come in and assess your play, tell you whether it's good or not play because you kind of match that against the rules. Where managerial accounting, it's more like practice, so you can tweak some of those rules as needed within the firm. So managerial accounting inside the firm, financial accounting for external users. And because we have external users, you're going to find out there's a more stringent set of rules. ethics in a business. Basically, we want the financial reports to be accurate. If you're going to use it, you want to make sure that, or you would like to know that what you read is truthful, and so that accountants actually put those together, so you want them to not lie. So basically, we want to make sure our accountants, what they have is trustworthy. There's a lot of companies that have gone bankrupt over the years. Enron is probably one of the ones you may have heard about, but basically they had more than 60 billion in stock market losses. People lost their jobs, people lost their retirement accounts that were invested in Enron stock. And I have known people who had worked for a college in Houston, Texas at the time Enron went under, and students had to pull out of school because their parents lost their jobs. So basically what happened is the financial statements were misstated. They just lied on the financial statements, and people bought the stock as a result, and the economy was hurt. As a result of Enron and WorldCom and some of the accounting standards or fraudulent activity, Congress passed a law called Sarbanes-Oxley. Sarbanes-Oxley is simply the name of the congressman who passed the law, but it established an oversight body of the accounting profession to kind of monitor it, so to make sure that there are some rules and regulations to try to prevent lying. And the Public Company Accounting Oversight Board just does that, oversees accounting, to try to make sure it doesn't happen again. They also established some standards for independence. So in other words, you cannot audit a business that you also do work for. So if I provide consulting services for a business, I can't do the audit because I'm not independent. I have a financial, I guess, I'm invested in the company doing well because I want to keep getting paid for my other work. All right, so ethics is very important in a business, and I like to define ethics as Arthur Andersen is the accounting firm that audited Enron and WorldCom, which were big financial failures. Arthur Andersen was the biggest accounting firm in the world. So if you picture a firm that you think is big, maybe Amazon pops in your mind, maybe Apple pops in your mind. So, or a sports team that is number one in your sports area. So picture that of a team that has just dominated the sports field. Okay, so Arthur Andersen was that to the accounting profession. They audited Enron and WorldCom, and in 4 to 5 months they were gone. They were out of business. So what accountants have to sell is basically their signature that says, I audited this, I looked at it, it is correct, and if no one believes them, then we don't need a job. And so that's how important ethics are to accounting, because the whole business system looks at financial reports and relies on those. And if those can't be trusted, then the whole system collapses. So ethics is very important. There are a lot of career opportunities in accounting. I hope some of you think of it as a career, but you don't always have to do what we do in this class to be an accountant. We'll talk about those. Okay, public accounting is where you work for a firm that goes around and audits other firms. So you may go audit Apple one day, and then that'll take you a few months, and then you'll go to another firm and audit them. But basically, you work for a public accounting firm. They audit public companies. And to do audits of public companies, you have to take a test and become a certified public accountant. Okay, so here's some career tracks. So you can just look at those and read them yourself. All right, so a CPA is a certified public accountant. They're the ones that can audit companies and double check their financial statements. All right, GAAP, Generally Accepted Accounting Principles. Okay, so let's say that you decided you wanted to come to Quincy University to play basketball. Okay, so you played basketball at Quincy University and you decided, gee, we as Quincy University's basketball team ought to go over to another college and play them in basketball. Okay, you know the rules. You know that the 3-point line, you can shoot the 3-pointer from there. You know that you have free throws and you know all of those rules. Okay, you don't go to the other school and they show you the rules when you walk in. They don't say, oh, we have a 4-point line, or we're going to call that a 5-point line, or we're going to shoot from out of bounds and that's 10 points. Okay, you know the rules before you go play. In the same way, generally accepted accounting principles are the rules for the financial statements. So if I pick up one set of financial statements from Apple, and then I pick up another set of financial statements from Amazon, I know that they were prepared under the same set of rules, so I can read them and I compare them. That's all generally accepted accounting principles are. Generally accepted accounting principles are basically just that. They are generally accepted, so there's not really a list of principles that you can go find. A lot of these come from various sources. However, there are standards, there are rules, there are principles, etc. And then there are other things that everyone just does that are generally accepted. So it's really needed because financial statement users, usually investors and creditors, have to be able to make comparisons. So if you're going to buy Apple versus Amazon, you need to look at it and make comparisons to see who did better. Otherwise, you couldn't really make those comparisons if everybody just followed their same rules. So the same way, if you want to go watch a professional sports team and assess who did better, and one of them, you want to assess who does better in a baseball game, and you're going to see who gets the most points. But one team has a 40-inning game and the other one has a 2-inning game. You can't really compare them. You have to have the rules. The Financial Accounting Standards Board has the primary responsibility for developing accounting standards. Remember that there are several sources of generally accepted accounting principles, but the FASB has the primary responsibility. In other words, they set the highest level of rules. Those are the ones that if any other rule, if they set the rule, it has to be followed. Other things are just generally accepted and everyone does. All right, and after the stock market crash of the 30s, Congress established the SEC to set the accounting standards. The SEC looked around and figured out, well, our problem is not that there are no standards. The problem is that there's no enforcement of the standards. So the SEC took over the enforcement rule, and while the FASB sets the standards. So they kind of have the authority over the accounting and financial disclosures, but they accept the FASB standards. The International Accounting Standards Board sets international accounting standards. Most countries outside the United States follow international accounting standards. We look at those as they're adopted, and we may adopt similar ones, but we do not have to adopt similar ones. We follow GAAP. A couple other items that are important is financial reports have two important characteristics. They're relevant and faithful representation. So we can't put everything in a financial statement, but we try to put all of the relevant information, all of the important information, all the important information that has the potential to impact decision making. We try to get in there. You're going to find out we don't always succeed in that. Some things are just too hard to get in there. For instance, the value of human resources. So if I ask you, how much is Bill Gates worth to Microsoft, you may say a lot. However, we can't right now value human resources. We can pay somebody a salary, so that is kind of our, I guess, what we would use to kind of be a substitute for the value, but I think we all know that some years we might get paid more and we're worth more to the firm than other years, just because we have other things going on in our life. But relevant, we try to include all relevant information, and faithful representation means we try to make the financial statements as accurate as possible. Here are some other things that we're going to talk about, and I think the other slides do. Monetary unit, we basically want to keep ours in US dollars, which basically means if you have a subsidiary in another country, we're going to convert those to US dollars so we can put it on our financial statement. Time period assumption. We follow generally in financial reports, we follow a year. Why? Because the year was already set up by the Gregorian calendar, so we decided to, what other time period would you use? So basically, if I'm going to compare, and I'll use Apple and Amazon again, I want to compare them over the same time period, which is a year. I wouldn't want one company to use 6 months and the other company to use 18 months. And the one that says 18 months says, hey, I did a lot better. But if I look at it, they have a different time period. So I want a consistent time period. Business entity assumption. A business is separate from its owners, so I don't want to commingle what I did with my business. So if I have a business that sells t-shirts and I did tutoring on the side, I would keep my t-shirt business separate from my tutoring. So the business is separate from the owners. Some different forms of organization. So you're going to go skip down here. I think we come back to going concern. You have proprietorships. These are under the entity concept, really. Proprietorship is owned by one person, partnership 2 or more. Corporation is organized under state law, and it operates as a separate legal taxable entity. In other words, if you organize as a corporation and are sued, the corporation will lose maybe in the lawsuit, but you would never lose your house. So if you're formed as a proprietorship and the business gets sued, you could lose your house because you are part of the business. Even though the business is a separate entity, it's not a separate legal entity. Here it's a separate legal entity. And then there's a limited liability company that kind of combines the attributes of partnerships and corporations. So you can just kind of know they exist. I'll go back up here to going concern. So I might want to put a little arrow there. Those are different types of business entities. So we will basically assume that a business is going to keep going. When that assumption cannot be met, you have to make additional disclosures in the financial statements. But basically, we don't revalue everything as if it was a liquidation sale on our financial statements. We assume the business is going to keep going. Now remember, if this is not clear that you have a going concern, you need to restate that in the financial statements. Some other things that we're going to talk about, measurement, historical cost, revenue recognition. Basically, the measurement is how much are you going to report it at, and we want to make sure it's objective and verifiable. A lot of times that's an invoice, so if I paid $10 to a t-shirt, that's pretty objective and I can verify it. Okay, so that's what we're looking for. And if I get back to the Bill Gates example, why don't we measure the value of Bill Gates? Because we can't objectively measure somebody's value and verify it. Again, our salary is our surrogate for it. But if you think about, again, yourself, you may do great things for the company, and then the next year you're injured or you have a family and you take a few weeks off and you get paid for that time off. Obviously, if you're not at the firm working, your salary doesn't really measure what your worth is. So we tend to not value human resources besides the salary that we pay. Arm's length transactions are basically between two independent parties. So if I sold you my car, since we are unrelated, we would say it's arm's length, whereas if your parents sold you your car, you wouldn't necessarily trust it. Historical cost principle means we record things and we leave it on our financial statements at historical cost, what we originally paid for it. Revenue recognition principle is you recognize the revenue when the services have been performed or delivered. So when the work has been done. So under revenue recognition, it's when the service has been performed or the goods are delivered. And basically you can put yourself in big bold letters, this is not when the cash is received. It's when the work is done, not when the cash is received. And the expense recognition principle, I should have added matching here to it, probably will on your handout, so it may have matching on it. The matching principle and the expense recognition principle are pretty similar. They say you record the expense in the same time period as the revenue. All right, the accounting equation, I'm going to go back and come back to it, but the accounting equation is that at all times our assets equal our liabilities and stockholders' equity. So what are our assets? Our assets are things the business has, owns, that are current or future benefit. Resources that the business has that are current or future benefit. Okay, liabilities are things the business owes, and stockholders' equity are the rights of the owner. So if I go back to this accounting equation, here it is. So if I have a car is something I have of current or future benefits. So let's say $10,000. How did I get that car? If I borrow all the money, I have a $10,000 car, but my liabilities are $10,000, so I owe on that car. But if my assets are $10,000, I have a car, and I got it from investing it in the business myself or from the stockholder, then my stockholder's equity is $10,000. I could also have a $10,000 car that I borrowed $4,000 of it and bought $6,000, invested $6,000 of my own money. So $10,000 car equals $4,000 plus $6,000 is $10,000. Business transaction, we're going to be analyzing those. You'll know what those are. And I'm going to skip through these pretty quick. So the business got $25,000 from the owner, so assets went up. The asset that went up is cash, and owner's equity also went up. And we call the owner's equity common stock. Next one, they paid $20,000 for purchase of land as a future building site. So what happened? Cash, I paid $20,000, so cash went down and land went up. So I exchanged one asset for another asset. So notice the accounting equation still equals 25 equals 25. Next one, they purchased supplies for $13.50 and agreed to pay the suppliers in the near future. So what did I get? I got supplies, so my supplies go up. How did I get my supplies? I promised to pay for them later. So I have an account that is payable. I call this accounts payable. It's a liability I owe. So I got supplies, but I owe on it. So again, in my individual transaction, my assets equals my liabilities and owner's equity. And overall, my assets equals my liabilities and owner's equity. A revenue is when I do what I'm in business for. So I earn money by selling goods or services. So I earn a revenue. So you're going to find out that I get an asset, but I earn a revenue. So when I earn revenue, I get cash, which is an asset. So we'll do some of those transactions. So they received cash of $7,500 for providing services. So what did I get? The business got cash, and cash is an asset. And how did I get it? I got it by earning a revenue. And so fees earned is my revenue, and that's part of stockholders' equity. Some revenues are sales, rent revenue, interest revenue. An account receivable is an asset. We'll do some transactions together. Okay, expenses are costs of doing business. So every time I incur a cost of doing business, I have an expense. And so I pay the following expenses. Wages expense. So I record my stockholders' equity is going down because I'm paying money out of the business for wages, out of the business for rent, out of the business for utilities, out of the business for miscellaneous expense, and my cash is going down. I paid creditors on account $950, so I got rid of cash, and my running total of how much I owe people is going down also. So I owed people $1350, now I paid them $950, so now I only owe them $400. So again, my assets equals my liabilities and owner's equity. And down here in total, my assets equals my liabilities and owner's equity. They determined the cost of supplies on hand at the end of the month was $550. This is kind of a complicated one to have in chapter 1, but now look at your supplies. I had $1350 on hand. I said there were $550 left, so I must have used $800. So sometimes I determine how much I've used by go counting them, and whatever's not there has been used. So if I've used it up, it becomes an expense. So I record it under supplies expense and take it out of supplies. I paid a dividend. Dividend is money going out of the business into the owner's pocket, so cash is going down, and dividends are a reduction in stockholders' equity, so I record my dividends. So basically what it looks like, so notice my accounting equation is assets equals liabilities plus stockholders' equity, and if I add all these transactions up, so the supplies went from $1350, I subtracted $800, it down to $550. You don't necessarily need to subtotal on all these, just subtotal at the very end. Okay, and just make sure these two equal. Your assets have to equal your liabilities and stockholders' equity. Two components of stockholders' equity are common stock and retained earnings. So this is important. This is owner's investments, and these are what the business has earned. Now you can go through this on your own. There are 4 financial statements. The income statement, the retained earnings statement, the balance sheet, and the statement of cash flows. The income statement has revenues and expenses on it, so it's how much I made minus my expenses. So revenues minus expenses equals net income. The retained earnings statement, remember there are 2 components of stockholders' equity, is earnings that are kept by the business, so it's a summary of changes in retained earnings. We'll go into those later. The balance sheet is just the accounting equation, assets equals liabilities plus stockholders' equity on a specific date. So notice the income statement, retained earnings statement, and cash flows cover a period of time, whereas the balance sheet's as of a specific date. I like to show it like this. So if I start my business today, I have a balance sheet. Assets equals liabilities plus owner's equity of what I have today. And if in a year from now I do a balance sheet, show what I have at a date at a specific period of time, I'll see my assets, liabilities, and owner's equity. So let's say I have $10,000 in cash. But in a year from now I have $8,000 in cash, a $15,000 car, some stock investments, some land, and I owe a little bit of money, etc. So my question is, how did I get from just having $10,000 in cash to having all this stuff? And the answer is I look at my income statement. So your income statement, retained earnings statement, and cash flow cover a period of time to show how you got from this balance sheet to this balance sheet. So notice for a specific period of time, for a specific period of time, for a specific period of time, whereas this one, the balance sheet is a specific date. Okay, and we'll see how those fit together. So you can see that the income statement has your revenues minus expenses. Hopefully you make a profit. Your retained earnings statement and your balance sheet. You can do it in report form. These forms are not important. The 3 sections of the cash flow are operating, investing, and financing activities. Operating activities is what I'm in business for. Investing activities is what I invest in. I can either invest in my business. So if I'm have a lawnmower business, I would invest in buying a lawnmower, or I can actually make investments in stocks and bonds. And financing activities are basically how I finance my assets. So they are debt and equity transactions. You can look through those. And the last thing that we're going to cover in this chapter is the ratio of liabilities to stockholders' equity is just simply total liabilities divided by total stockholders' equity. So basically this will tell you if you have more stock liabilities or more stockholders' equity. So if you have more liabilities, your numerator will be higher, so it'll be greater than 1. If you have more stockholders' equity, it'll be, your denominator will be higher, so it'll be less than 1. So in this case, they have a lot more equity than liabilities, so 0.015. So they have very little debt to their equity. So you can see that they're in a very good position to pay their creditors. And that's it.